Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 16th, 2026. Hey, I hope you're doing well. I hope you had a good trading week. I hope you're going to enjoy your weekend, and I really appreciate you coming to my weekend review podcast. I hope you're going to find it informative and helpful. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to look at all the trades, all the positions that I have and made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signals were, what the confluences and or combinations of signals were of how I entered the trade, and I'll explain all of that. We'll talk about how I position size based upon my current uh, account value and also the current market volatility. We'll talk about where I place my emergency stops, where my end of bar stops are, how I take partial profits if the market moves in the direction that I want it to, how I go into trailing stop mode and what that means, and then ultimately how I exit the trade. So we'll talk about when I entered the trade, why I entered the trade, and most importantly, how I'm going to manage these trades going forward. I had a pretty good week. Was grateful for that. Of course, the market came back to yesterday on a Friday, which was kind of interesting. But all in all, pretty good week. Had some winners, had some losers, but the most important thing is that I had more winners than losers, and what I made on those was larger than what I lost. And that's really all we can ask for in trading. You're always going to have losing trades in trading, but you just want to try to keep those losses small and structure your trade so that if you have a losing trade, if with a good risk to reward ratio, that your losses will be small, but you always have the chance of having an outside gain. So after we go through the positions, then we're going to talk a little bit about trading psychology. It's always the most important skill in trading, everybody. For sure, bar none, the ability to create a plan and follow it. There's a lot of good trading plans out there. There's not a lack of those. There's a lot of good ones, but the important thing is you have to follow your plan. You can have the best trading plan in the world, but if you don't follow it, it's just no good. And that all comes down to trader psychology. So I always like to cover this in the Weekend Review podcast. And it's always helpful for me to teach it, and I hope it's helpful for you to hear. Maybe you'll hear something one day that will resonate with you and it will improve your trading. I hope so. That's why I do it. And then last night I went through my master watch list and I have identified some potential trades for the upcoming week. Now, these trades are not where they need to be yet, but they're getting close. They're getting within striking distance of some key levels. And when I talk about key levels, I use different levels. I use order blocks. I use major moving averages. I use 30 RSIs. I look for double bottom bullish divergences. I look for V1s. I look for V2s. And ideally, when all these come together, if you have a trade that has all the things that I just mentioned, those are your best trades. It doesn't mean it's going to be a winning trade, but it's going to improve your chances a lot. So I went through the watch list last night and I have identified some ones that are within striking distance and certainly could trigger next week if they reject certain levels. And so I'll go over all those with you. I'll tell you the levels, and hopefully that will be helpful. If there is anything that is helpful or valuable to you in the podcast that you hear, I really would appreciate it if you could hit the thumbs up button. It really helps to build the channel, let YouTube know that there's some valuable content so they can get it out and share it with more people. All right, so let's get this U.S. legal disclaimer out of the way quickly, and then we'll come back and we'll get rolling. So hang tight for about 40 seconds. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me. And let's get started on the first position, that one of my current open positions that I have, and that is Southwest Airlines. LUV is the ticker. So you'll see the majority of the trades that I'm going to show you are a combination of different strategies, different systems. And this particular trade that I took on Southwest Airlines here on the 30th of April at 37.83 is a combination of a rejection of a 200-day moving average. This is called a deep dip buy strategy, and an order block strategy, which is the green box here. And you can see that I took the trade when both of these signals happen, and I'll go over in detail what the signals were, but they're a combination of signals. I keep talking about combinations, confluences of signals. So let's first talk about what an order block is. An order block, majority of my trades, I would say close to 85% of my trades, maybe 80, yeah, about 80% of my trades involve an order block. Order blocks are seriously helpful for traders. And so let me first show you why this is an order block. So in order for us to have an order block, we first need what is called as a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So there we go. Right here on the 31st of March, we have a swing low. So that's the first requirement. I need to find a swing low. After that, I need to find a swing high. A swing high is just a high that has a lower high to the left and a lower high to the right. So now we have two. We have a swing low followed by a swing high. Perfect. That's what we need. The next thing we need is another swing low that is lower than the first swing low. Well, here you go. This is a swing low, and it is lower than this swing low. So we have three things, 3 out of the 4 that we need. We have a swing low, followed by a swing high, followed by a lower swing low. After you have that lower swing low, in the future, if the price goes above the high of that first swing high, remember this is the swing high, swing low, swing high, lower swing low. In the future, if the price moves above that swing high, like we did here, this bar clearly went above here, now you have what is called a structure change, a bullish market structure change. The structure of the market is now bullish, okay? And as soon as you take out that swing high, the lowest closing bar prior to the market structure change, the high and the low of that bar is your order block. And so, oops, sorry, I moved that. There we go. So the high, the lowest closing bar prior to market structure change, the high and the low of this bar, I move this into the future. And so let me show you why this is important. So when you have a swing low, you have a swing high, you have a lower swing low, you change market structure. Once you change market structure to the upside, I'm looking to buy dips. That's one way to think about it. The other way to think about it is if you have a swing low and a swing high and a lower swing low, and then the market breaks structure and goes way up here, do you think it's fair to say that when the price is way up here at $43 and the order block was down here 37 to 35, that smart money was buying this? Yeah, in hindsight, for sure. I mean, when you're up here at $44 and now you look back here, was this smart money? Yeah, 100%. It was smart money. So if you have a swing low, swing low, swing high, lower swing low, market structure change, and it starts to trend up, now I can look back and say with confidence that this was the smart money area. So I want to move the smart money area into the future so that in the future, if we come back down to the smart money area, if the smart money area worked before, does it mean it has to work this time? It does not. But I've traded for over 30 years, and more times than not, if it was smart money, it's smart money again. Not every time, but that's the idea behind order blocks, is that these were smart money before it took off, and so when we come back down, it has a better chance of being smart money again. Okay, so then I took the trade here on the 30th of April. Why? Well, for one, There's two reasons. With an order block, you can take a rejection of the high of the order block, or a rejection of the low of the order block, or you can take a rejection of a major moving average inside the order block. So on the day that I took the trade, not only did it reject the high of the order block, meaning the previous day was in the order block and then it closed above the order block, which by itself is a legitimate signal, but we also had a close under the 200-day moving average and a close over the 200-day moving average, which is the black line. Again, this is a deep dip buy signal, but a close under the 200 and over the 200 just by itself is a legitimate signal. But when it happens inside the order block, it becomes a much stronger signal. So it's a key level, key signal, a key signal within a key level. So that is the reason that I took the trade. The previous day it closed below the 200. Now it closed above the 200. So as soon as I took the trade, and then I have to decide, well, how many shares am I going to buy? And I have a very simple formula that I've used for a long time. I simply take 1% of my account. So if I have a $100,000 account, 1% of that is $1,000. And then I look to the value of the 2 ATR. ATR just means average true range. It's telling you how much this stock moves on average in any one day, and I times that by 2, and this helps me measure the volatility. If this number is higher, that means the volatility is greater. If it's smaller, then volatility is less. So 1% of my total capital, 1% times 100,000 is $1,000 divided by the value of the 2 ATR, 301, is telling me 332 shares is the correct amount of shares for me to buy based upon how much I have in my trading account and what the volatility is. And we did this math based upon 1%. So my maximum allowed loss on this trade is $1,000. Now, most of the time, if I have a losing trade, it's not going to be $1,000. It will be much less. But I have to know that I have a maximum amount that I'm willing to lose. And so 1% of my account is the maximum amount that I'm willing to lose. So close under 200, close over 200, rejection of the high of the order block. I buy 332 shares, and I did at 37.83. First thing I do now is I take my entry price minus the value of the 2 ATR, and I put this red line down here. This is my emergency stop. So I entered here. If it comes down all the way to my emergency stop, how much am I going to lose? I'm going to lose $1,000, right? Because we did the math. 1,000 divided by 301. So that's my worst case scenario, essentially. It could be worse in some cases if it gapped below that. But in general, that's going to be my worst case scenario. Oh, but it only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it's going to be because of my end of bar stop. Red line's my emergency stop. My end of bar stop is this 200-day moving average because that's why I took the trade. It closed below the 200, then it closed back above the 200. In the future, if we closed below the 200, I would get out. I would have a losing trade, but it would be nowhere near the 1% if it went all the way down to here. So position sizing is extremely important. I think it's probably the most important decision you're going to make on any one trade. So that's the formula that I use. So, okay. So we know where the emergency stop is. On this particular trade, my end of bar stop's a close below the 200-day moving average. The next thing I do is I take my entry price, which was 37.83, and now I look to the value of the 1.5 ATR. Right now it's $2.25. I take my entry price plus whatever the value of the 1.5 is, and I place that above my entry. And the reason that I do this in trading, if you take a trade and it starts to move the direction that you want it to, for me, if it gets 1.5 ATRs above my entry, that's a good move. And I don't want to risk giving everything back. So once we get to this trailing stop level, 1.5 ATRs above my entry, now I go into what is called trailing stop mode. It doesn't mean I do anything that particular day. It just means once I touch that orange line, Now in the future, if I have a close below a previous bar's low, I'm going to exit half. And this particular example shows you exactly why I'm going to do that. Okay, and I'll get to that in a minute. Okay, so everything I've talked about so far, the emergency stop, the end of bar stop, going into trailing stop mode, these are all defensive moves, meaning that if the market moves against me, I'm going to have to take some type of action. So everything's defensive so far. But I also like to play offense in my trading as well. And the way that I play offense is that I take the closing price of the day, I add the value of the 0.45 ATR to it, and that becomes a profit target for the next day. And I place 3 profit targets every day. So let me just show you, I'm still in this trade. So let me show you exactly what I mean so I can be a little bit more clear. At the end of the day, I look at the closing price, which is now $38.50, and I take the value of whatever the 0.45 value is on that day. Right now it's 68 cents. So for Monday, I'm going to place my 3 profit targets. Closing price plus the value of the 0.45 ATR plus 0.68. My first profit target for Monday is 39.18. So let's just put it there, 39.18. That's my first profit target. I'm going to place a second and a third profit target as well. So I place 3 every day. So my first profit target is 39.18. Now I just add the 0.45 to it again. My second profit target for Monday is 39.86. And I'm going to do it one more time. I'll take the second profit target, which is 39.86 plus 0.68. My third profit target for Monday is $40.54. Now, the question is, those are my profit targets. How much do I get out at each profit target? It's very simple. 10% of however many shares I went into the day with. If I go into the day with 100 shares, 10%, it's 10 shares. 10 here, 10 here, 10 here. Doesn't mean I'm going to hit all 3. Doesn't even mean I'm going to hit 1. But if I do hit 1, at least I'm selling into strength. If I have a really good day, maybe I take out 2. It's great. I'm locking in profits. I'm reducing my position size. I'm reducing the stress of the trade because my position size is getting smaller. And that's a real benefit. The less stressed you are, the more likely you are to follow your process. If I have a great day, maybe I hit 3 profit targets. I've hit 3 profit targets many times. I've hit 7, 8 profit targets, but I don't spend the time to put 7 or 8 in because it just doesn't happen. If it happens, if I hit my third, then I'll just go in and manually put a 4th and a 5th and a 6th. Okay, so and maybe I don't hit any. And maybe it goes down more on Monday, and then I start with 3 new profit targets from the new closing price. So I'm a real big proponent of this, and and I'll show you exactly why it was so important and the benefits of this. So, all right, so let's start. I just kind of laid the groundwork of everything. So let's just now look at the trade. Why did I take the trade? Close under, close over the 200-day moving average inside the order block. I entered at 37.83. I position size correctly. I placed my emergency stop 2 ATRs below. If it gets down there, I'm going to lose 1% of my account, but that only happens about 5% of the time. The other 95% of the time, if I have a loss, it's going to be because it's going to be a close below my end of bar stop, which is simply a close below this 200-day moving average. I place my trailing stop level 1.5 ATRs above, and off we go. Next day, boom, moves up nicely. I hit multiple profit targets into that strength. Perfect. Next day down, next day, but it closed above the 200, so I can stay in the trade. Next day up again nicely. I sell some more partial profits into that strength. Next day up nicely, really big, multiple profit targets into that strength. And on this particular day, We got to the orange line. We got to trailing stop mode. So now it means I'm in trailing stop mode. It doesn't mean I do anything right this moment. It just means in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day, gapped open, went up, hit a profit target at the top there. Next day, unchanged. And then the next day, look, this is our first close below a previous bar's low. After reaching trailing stop level, what do? I take off half of the remaining shares that I have left. And I'm going to have fewer shares than I started because I've been selling in this trade. So I took off half there for a gain of 5.38%. Next day, continued down. So I'm glad that I sold half of what I had. Next day, down again. Next day, gaps up, goes up. I hit a profit target into that strength and then down today. So going forward, if Monday we close under this 200-day moving average, that's it. I'm done. That's my end of bar stop. But do you see the value, especially in this particular example? I sold when the market gave it to me. Had I bought here and not done anything, yeah, I'd be up a little, but I'm up a whole lot more because I'm taking those partial profits. And look what my trailing stop did. It got me out of half of the position here. Like I said, once you get to a certain distance above your trade entry price, I don't want to give it all back. Well, if you get there, I'm not doing anything. But then if you get a close below previous bar's low, that's a red flag that you could be headed down. And that's why I do it. And you can see. So the balance of the trade is still positive, up 1.71%. But very good example of why going into trailing stop, why I use trailing stop mode, and why I take partial profits when I have them, because I made a whole lot more than just buying it and holding it and being a little more active with it. So the remaining shares of 1.71%. UNG. Okay, UNG is a little bit of a different trade. This is I just got done telling you about taking partial profits, going into trailing stop mode. All of the trades except for one strategy, that's what I do. But this particular strategy, I make it very simple. I don't go into trailing stop mode. I don't take partial profits. I like to diversify my approach. But let's start out of why I took the trade in the first place. So the three bars you see over here, highlighted green, these are called a island reversal. An island reversal happens when you have a gap down and then you have more than one bar kind of go sideways and then you have a gap up. So the gap down here, sideways, and then the gap up. You see how it leaves these three bars here kind of like their own little island? That's why they call it an island reversal. And you can see when that happened, boy, it really went shooting up for a while anyway. But what's important to know is when you have an island reversal, the top of the island reversal is a very strong level of support. So in the future, if you come back to the top of that island reversal, that's where I like to enter. But I should also say comes back down to the top of the island reversal and rejects it, meaning it touches it, closes back above it. Well, that's what happened here on the date of my entry at 4:15. On this particular day, we touched the high of that island reversal in the past and then closed above it. So that is why I entered the trade, and I entered the trade at $10.57. So with this particular strategy, with an abandoned baby strategy or an island reversal strategy, they're exactly the same. It's just the abandoned baby is one bar, island reversal is more than one bar. What I do is I position size and I place my 2 ATR stop below. And as you know, if it goes down 2 ATRs, I'm going to lose 1% of my account, okay? But to the upside, I double that. So I'm risking 2 ATRs to the downside, and I place a 4 ATR profit target above. So I'm risking 1% of my account to make 2% of my account, right? And now I'm doing this I started this trade because it rejected a key level. So my anticipation for this trade is it's more likely to go up than it is to go down. Or in other words, I'm more likely to make 2% than I am to lose 1%. I can certainly lose 1%, but more times than not, I make 2% instead of lose 1%. So I put a 2 ATR stop below, a 4 ATR profit target above, and I just let this go. I have an order to sell if it gets up here. I have a stop order down here if it gets here. And I'm just going to let it go. And eventually, for sure, I don't know which direction, but I'm either going to lose 1% of my account or I'm going to make 2% of my account. And we started off really good, then we came down, and then we've been all over the place. And then natural gas has rallied pretty well. So my exit is 12.21 for the profit side, but currently this particular trade at the moment is up 6.88%. And again, I entered with the rejection of the high of a previous island reversal. So it's working out pretty good so far, 6.88%. Silver, very similar. Well, not exactly similar, but similar. So I was just talking to you about island reversals. Island reversals happen when you have a gap down, you have sideways movement, and then you gap up. Well, this is highlighted here in blue. This is what's called a bullish abandoned baby. It's the same concept as island reversal, other than it's just one bar. You see how the previous day we gap down, and then the very next day we gap up. And when you get these rapid gap downs followed by gap ups, very fast sentiment changes from bearish to bullish, this is generally a bullish signal. So that's one of the reasons I took the trade. The other reason I took the trade was here on the 17th, we closed in the order block, the green box. The next day we closed above. So that's a rejection of the high of the order block, and it's a bullish abandoned baby. So because it involved a abandoned baby or an island reversal, I did the same thing that I just did on natural gas. I placed a 2 ATR stop below me. If I get there, I lose 1%. And I place a 4 ATR profit target above me. If it gets there, I make 2%. So I'm risking 1% to make 2%. All right. So this trade has been all over the place. Remember, I'm not managing this trade other than hitting my stop or hitting my profit target. And it started off great. Started off really great. Perfect. I was like, get up there, get up there. It didn't quite get close. And then we came back down, and then we moved sideways, and then we rallied, and we went down. And the last 2 weeks, it was really doing well, starting its move up. But over the last 2 days, silver's really got clobbered. So I was nicely in the money on this trade. And at the moment, this particular trade is down 1.2% after being up like 6 or 7%. So anyway, I'm just riding this one out. Like I mentioned, for sure, in the future, I'm either going to lose 1% of my account or I'm going to make 2% of my account. But sometimes I like to have these slow, easy trades, starting with a good idea of why I entered, right? To skew the odds in my favor that I hit my profit target instead of my stop loss. But it's kind of nice. Like it's not stressful, and I know one of these two are going to happen. But anyway, this particular trade at the moment, down 1.2%. VIX. All right. You know, I really like the VIX in the context that I'm going to show you. One, for trades, and two, for getting a general idea of the market. So we have an order block that started here on the 25th of February. Now, why is it an order block? Well, remember, we have a swing low, followed by a swing high, followed by a lower swing low, and then a market structure change. And so VIX went from 27 up to 39. And again, when VIX is up at 39 and I see the order block back at 27, Is it fair to say that smart money was buying here? For sure. I mean, went from 27 to almost $40. Yeah, clearly smart money at the time was buying here based upon what happened. So I know this is smart money area. So I have the high and the low of the lowest closing bar before market structure. I bring it into the future. If the prices come back down, they're coming into what was previously smart money. Doesn't mean it has to be smart money again, but previously it was, so it makes sense to me to take the trade. So I did get long VIX on May 1st at 28.20. I position sized. I placed my emergency stop as always 2 ATRs below. My end bar stop is simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. Next day took off, hit some profit targets into the strength. Then we pulled back. We came back into the order block, but we never closed below it. Kept me in the trade. Next day moved up, profit target. Next day up, profit target. Down, profit target, down. This one got a little scary. It looked like it might close below, but it didn't. This morning we had a huge gap up where I took some profit targets at profitable levels, and then we reversed on the day. So this particular trade is currently down at the moment at 1.15%. But the other way that I use VIX, and I tell other traders I know and students that I work with that listen, if we get back to this smart money area in VIX, very likely that may be the top of the market, because if VIX bounces from here, what's the market going to do? Well, if VIX is going up, pretty safe bet to say the market will be going down. Not always, but more times than not. So we are, ever since we've been down here in this order block, I've been concerned about a possible, at least short-term market top. And after today's sell-off, it was right. So I am going to stay in this trade. If it continues up, I'll continue to take profits. If I get to trailing stop level, I'll go into trailing stop mode. If it closes below the order block, then that's it. I'm done. The trade didn't work. All right. So that's VIX. Exxon has been a really good trade. I entered Exxon here on the 8th of May at $144.41. Why? Well, we have an order block. Here's the swing low, here's the swing high, here's the lower swing low, here's market structure change. As soon as it changed market structure, lowest closing bar prior to market structure change, the high and the low in the green box, bring it into the future. If we get back down in the smart money area, I want to look to potentially buy. We had a nice 100-day moving average, which is the red bar inside of the order block. Again, key level within key level. I got long here on Exxon with a rejection because it rejected this 100-day moving average, 144.41. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop would simply have been a close below this 100-day moving average. You can see how close I entered to the 100. So very next day, if it closed below just a penny, I could simply gotten out for a very small loss and said, okay, this trade didn't work. I placed my 1.5 ATR trailing stop level above, and here we go. Next day, took off like a rocket ship, which not all the time, but more times than not, when I take a rejection of a major moving average inside an order block, a lot more times than not, the next day it's up, because a lot of savvy traders see this particular trade. So the next day it was up right off the bat, which was perfect. I hit multiple profit targets into that strength. The next day up a little bit more with another profit target, also hit trailing stop level. Now I'm in trailing stop mode. It doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Well, it just moved sideways the next day. Next day was up. And today was up massive. 3 profit targets today on this move up. So this trade is doing very well. I'm in trailing stop mode, but haven't had a close below previous bar's low. So 1, 2, 3, 4, 5. In 5 days, this particular trade is up 8.5%. But this is a very good example, everyone, of waiting for the price to come down to a key level, reject a key level, position size correctly based upon position size market volatility, having a very good starting risk to reward ratio so that if I'm wrong, I can be wrong small. And if I'm right, of course I have the potential for a big upside win. That's exactly what happened. Plus I got a dividend today of $1.03, which is crazy. So it's actually up more than 8.5%. So anyway, really great trade. We are at a 60.69 RSI. If we get to 65 RSI, if it keeps going up and I get to 65 RSI, now this 5 EMA will come into play. And so if I get to a 65 RSI and then it closes below the 5 EMA, that will be the end of my trade. I will also get out of half if it keeps going and rejects the 70 RSI. And once it rejects the 70 RSI and I sell half, then if I have a close below previous bar's low, I'll exit the remainder of the trade. But this is a textbook perfect example of a good risk to reward ratio, a rejection of a key level within a key level, and up 8.5%. LMT. All right, same thing. This is a combination of a deep dip buy inside an order block. I entered LMT here on the 11th of May at $512.08. Why? It was a close under and a close over the 250-day moving average. So I entered 512.08. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 250-day moving average. This is the purple line. I placed my trailing stop level 1.5 ATRs above. Next day, we moved up, hit a profit target. Ever since then, we have just moved sideways. We're not at trailing stop level. We haven't closed below the 250. There's only been one profit target in this entire trade, and the remaining shares I have are up 0.7%. So at least they're up. But this is very interesting to see Lockheed Martin in this sideways motion. I'll tell you one thing about sideways motion. I can guarantee you this is going to trend. I don't know when it will trend, and I don't know if the trend's going to be down or up. But the one thing about trading that I know for sure is that sideways motion leads to trends. Trends lead back to sideways motion. So for sure, this is going to trend either down or up. I just don't know the direction, and I don't know when it's going to happen, but it will happen. So the remaining shares here, still in the trade, hasn't done much, up 0.7%. DoorDash. All right, I took DoorDash on Thursday, the 14th, at 153.70. So why did I take this trade? Well, we have an order block back here, swing low, swing high, lower swing low, market structure change when it took out this swing high. And again, when prices were up here at 190 and the order block formed down here at 150, was smart money buying here? It was. When you look into the future, it's much higher. Clearly, I think you can make the case that was smart money. And if you've been watching the channel, I said, look, if we get back to this smart money area, that's where I'm going to be looking. So this particular order block does not have a moving average inside of it. So there are times where I make my own key level, and the key level was a rejection of 150, 140. So why 150, 140? Well, if we go back to these three bars are called a V2. A V2 happens with three bars. You have bar 1, bar 2, and bar 3. And the rules are that bar 2 has to go below bar 1's low, which it did. Bar 3 has to close above bar 1's close, which it did. So when this happens, that's an entry trigger, and you can see it did work. But the key level inside of a V2, a key level of support is halfway up the second bar. We call the second bar the washout bar because it goes below or washes out bar 1. So I know that halfway between the high and the low of bar number 2, there's going to be some inherent support. Not always, but more times than not. So that was my key line in the sand. So I brought this into the future. Now, Wednesday we closed below, so there was no trade. At that point, if it went lower and rejected the bottom of the order block, I could have got in there. But I took the trade on Thursday because we closed back over that level. So I entered 153.70. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 150, 140 level. So I have a good risk to reward ratio. And of course, I placed my 1.5 ATR trailing stop level above. Today was up on a down day, which I was grateful for that, and I sold one profit target into that strength. So this particular trade, at the moment, the remaining shares are up 3.44%. So it was a good start. Now, yesterday I was looking at Roblox and Dash, and they were both legitimate trades. And I decided at the last moment, all day long, I liked Roblox better. But at the end of the day, I said, I understand DoorDash business model more than I understand Roblox, the game. And I mean, I know what they do, but I don't really understand much about it. And that's the reason I decided to take it. And the other reason I decided to take it, it was something kind of out of technology, which I was looking for. And I guess Dash is a little bit technology driven, but it's food delivery. So that is why I took Dash over Roblox. But I did take Roblox today, and I'll explain why. But anyway, good start to a trade, up 3.44%. And then today I took RBLX, which is Roblox. So why did I take this today? Well, we have this order block from the past, so we know that's a key area. If you go back here to the 13th, incorporating a deep dip buy, I'm usually talking about 200, 250, 300s, but I'm also talking about the 30 RSI. And this particular day, we closed just under the 30 RSI. And if you close under the 30 RSI and then you close back over the 30 RSI from a deep dip buy perspective, that is a legitimate trade. And so that's why I was looking at taking it yesterday, because two things: we closed under the 30, closed over the 30, which is legitimate. We closed in the order block, then we closed above the order block, which is legitimate. And we also rejected the negative third ATR channel. It's a good trade. It's a really good trade. But like I said, I decided to take DoorDash instead just because I like the industry a little bit better. That's really all it came down to. So I entered today. Why? Well, if I had taken the trade yesterday on RBLX, would I still be in the trade? Well, I would, because if you have a close under 30 and then a close over 30, my end of bar stops a close under the 30 RSI. It's still above the 30 RSI. It's 33.59. So had I entered yesterday, I would still be in the trade. So if I'm still in the trade, if I would still be in the trade if I bought it higher, I can buy it lower. I just bought it at a lower price than yesterday. Had it closed below the 30, I would not have taken the trade. All right, so I just got about a 2% reduction on where I would have bought it yesterday. But I like the trade. It's 33.59 RSI. Monday or next week, if it closes back under 30, I've got to get out. And it just entered today, so I'm exactly even on the trade. So just recap: Love remaining shares up 1.71%, UNG remaining shares up 6.88%, Silver remaining shares down 1.2%, VIX remaining shares down 1.15%, Exxon remaining shares up 8.5%, LMT remaining shares up 0.7%, DoorDash remaining shares up 3.4%, and RBLX even. So those are the current open trades that I have. Now, Nike, I did take a trade on Nike that I did get stopped out of at the beginning of the week. I took a trade here on the 5th of May at 43.06. So again, this is a combination. You see it's in an order block, the green box, but it did not have a moving average. So I wanted to find my own level. Well, you can see circled here in blue, this is an abandoned baby. Look, the day before we gap down, and then the next day we gap up. When that happens, that's a bullish signal. You can see it did work. But the key level on an abandoned baby is the high of the abandoned baby. So that's why I drew my line here at the high of the abandoned baby. And if we rejected it, that was going to be my line in the sand. If it rejects it, I get in. If it closes back below, I get out. Well, it rejected. 2 days, it went up nicely, thankfully. I hit some profit targets on the way up here before it had its move down, so I helped mitigate the loss. Didn't quite get to trailing stop level. But then here on the 11th, May 11th, we closed below the basically the entry point or that key level at the top of the band of baby at 43.06. So I had to get out of the trade for a loss of 1.51%. But you see how important, I mean, you see how I'm glad that I did take the partial profits when I had them, even though it ended up being a loss, it mitigated the loss. But the remaining shares, yes, a loss of 1.51%. So that was the trade. So again, if you look at all my open trades and the trade that I just closed, they're not all winning trades. But if you look carefully at the numbers, I have some that are pretty close to, break even. I had some losers, but the losses are small, and I had some winners that had pretty good outsized gains, getting close to double-digit gains on a couple of them. So that's when I know I'm doing my job. Not all winners, definitely some losers, but the losers being small and the winners being a lot larger than the losers. That's all we can hope for. That's all we can hope for. Okay, also, I did take a weekly trade today as well. So we're looking at the weekly charts right now. Every bar is a week. And actually, a couple of my students, Adam and Joy, I was mentioning this to them in our lesson this week because they're interested in trading weekly bars. And McDonald's has come way, way, way down. But look, we're coming into an order block, a weekly order block in this case. And also in this case, we have the 200-week moving average. So this is a key level if this level would get rejected. And it did get rejected this week. During the week, we went below the 200. And at the end of the week, we closed above it. Look, the 200 week is 276.05. We closed 276.39. That's above 276.05 on a closing basis. So I entered here today. Where's my entry? I got the wrong color. All right. So I entered right here. No, that's off. Sorry, I was right at the close, 276.05. 276.39, excuse me. There we go. So I entered here right at the close. Now, I have a very good risk to reward ratio. I mean, I'm almost at my stop already, right? So next week, next Friday, because these are weekly bars, I position size based upon a weekly 2 ATR. I place my emergency stop 2 ATRs below. It's way down there. If it gets there, I lose 1% of my account. But again, that only happens 5% of the time. The other 95% of the time is if it closes next week below this 200, I'll just get out of the trade, even if it's a little, even if it's a penny below. So I did what I could do. I was patient. I waited for McDonald's on this weekly time frame to come down into a key order block and reject a key level, which it did. It did reject the 200. It offers me a very good risk to reward ratio. I have my worst case scenario, and now I just let it go. Next week on Friday, if it's still above the 200, I'll stay in the trade. Of course, I have my profit targets for next week. If it goes up, hit some profit targets, fantastic. If it gets to trailing stop level, go into trailing stop mode. So this trade is break even at the moment, but I don't know if it's going to work or not. I have no control over it, but I've structured this trade so that if I'm wrong, I have a good chance of being wrong small, and if I'm right, I have a good chance for an outsized gain. So this one completely break even at the moment. All right. So those are all the open and closed trades. I hope you found that helpful. If you have any questions about anything I did there, please let me know. And right now, why don't we take a look at a post by Stephen Goldstein. Stephen Goldstein's very famous trader, very famous author and trading coach, has a great podcast, the Alpha Mind podcast. I was lucky enough to um, have been a guest on that for twice on that. So I appreciate that, Steve. And let's see what Steve has to say today. All right. Whenever I came to my trading with an attitude that I didn't know where the markets were going, I did well in the markets. Let's read that again. Whenever I came to my trading with an attitude that I didn't know where the markets were going, I did well in the markets. Whenever I came to my trading with an attitude that I thought I knew where the markets were going, I struggled. Interesting, right? Not knowing attitude forces you to step back, evaluate, be curious, be objective, be open minded, be open to new ideas and perspective. Thinking you know, that does the opposite. And everyone, this is so true. When I run across traders that tell me, oh, this is happening for sure, this is happening for sure, I mean, it's like nails on a chalkboard because they do not know what's happening. And if they have that attitude of you think you know what's going to happen, it's going to cloud your judgment. What Steve says here at the very beginning, whenever I come to my trading with an attitude that I didn't know where markets were going, I did well. If you don't know where the markets are going and you don't have any opinion on it, then you're going to follow your process a lot more. If you think you know where they're going and it moves against you, you're less likely to follow your process because you already think it should be doing something else. So this is hugely important, everybody. Go into every trade with the attitude of, could go up, could go down. Be open, be fluid about it. And just don't get cocky and, get into that predictive mode of where you think the market's going to go. And just like Steve says, whenever he got into that mode, he did not do well. Whenever he went into a position with an open mind of, well, it could go up, could go down, I don't know, I'll just follow my rules, he'd do better. So anyway, I think this is a really good post. Hope this is helpful, and thank you very much, Steve Goldstein. You can follow him at AlphaMind 101. All right, so like I mentioned last night, as I mentioned previously, last night I went down through my master watch list and I went through all the stocks in my watch list and I came up with kind of my candidates that I'm looking to potentially enter next week. Now, they're not where they need to be yet. If they were, I probably would have already taken them. But I'm going to go through very detailed what I'm looking for my trades next week. But I have 6 symbols to show you that are candidates, and I say this every week, but it is possible that Monday, for example, all 6 of these would trigger. So does that mean I would take all 6 trades? And the answer is no. I only take 1 trade per day, regardless of how many perfect setups there are. And so if I have multiple candidates, I have to narrow it down to the best one. And how do I do that? So I give every potential trade a quality score. For example, if I have a rejection of the 200-day moving average and that's it, I give it a score of 1. If I have another stock, for example, that has a rejection of the 200-day moving average and a rejection of the order block, there's 2 signals. Now that has 2, the first one has 1. I'm going to pick the 2. All right. Maybe I have 4 signals. Maybe I have 5 signals, which is great. But then I also have to look at the risk to reward. Is it a good risk to reward still with all those signals? If it's not, then I have to back that number out and take away. right? So it's kind of an objective kind of a thing. Then I also look at higher time frames. If I'm trading the daily time frame, I also look for clues on the weekly charts to see maybe if a key level on the weekly charts being rejected. So that's also something I factor into it. I also look at relative strength of a particular market. Maybe the market, all the markets are down like they were today, but a candidate that I'm looking at for today is up on a down day. Okay, that gets an extra brownie point, right? It gets a higher score. So this is how I look at trading. I think it's very important to take one trade per day. Um, the best one of the day just increases your chances. This is how I use it. This is what I teach my students. And if I could just put in a quick plug for a moment, I do teach private one-on-one lessons. I teach a 20-hour private one-on-one course. It's just myself and the student. And I teach my one-on-one student for 20 hours. We do a class 2 hours a week for 10 weeks. And it's a great class. I teach all the different strategies that I use. I teach you all the rules. We do a lot of simulation trading. And it's very important to me that my students succeed. It really, really is. And I teach students from all over the world. I teach people that have never traded before, all the way up to the hedge fund level and everywhere in between. So if you're interested in learning trading, if you're interested in having a very experienced coach that's been doing this for over 30 years and loves to teach, let me know. I would love to have you as a student. I will teach you everything I know. I just brought on a few new students, Adam and Joy, Charlie. Great having you guys on board, and I enjoy our lesson each week, and I think they're going to do great. They're really doing great in the lessons. But if you're interested, all you have to do is send me an email. My email is in the link of this YouTube video. And if you do send me a video or an email, I will just reply and say, hey, great, nice to meet you. Let's kind of do a get to know you call. It's not a sales call, I promise you. I just want to learn more about you and your trading, your trading goals, your trading challenges. And then it's a really good time for you to ask me any questions about the course. But like I promise you, it's not a sales call. I just want to put a face to the name, see if we're a good fit. So my email is in the link in the description for the 20-hour one-on-one course. And then secondly, if you like online courses, I have a really good online course available at udemy.com. I have the link in the YouTube description below. It's a great course. I've sold so many of those all around the world. And that course is the Deep Dip Buy course. It's 9.5 hours. It's a really good course. It's very affordable. It's between $30 and $50. And I've had such good feedback. And I think like 4.85 stars or something like that on the rating. So whether it's the one-on-one course with me or the Udemy course, there's two really good options for you if you'd like to learn to trade like I do. All right, so thanks for letting me put my plug in, and let's get on to what we're looking at, or what I'm looking at for next week. So first up is Cameco Corporation, CCJ. So on Cameco, we have an order block from the past back here on 320. We bring that order block into the future. Now there's no really key levels inside this order block, but at the bottom of the order block, you can see the 200-day is just creeping up. By the time Cameco, if it continues down and gets down to this 200-day moving average, this 200-day moving average may be inside this order block. And that's really what I like to see. I like 200s, 250s, 300s inside an order block. Now, if the 200 is below this order block, would I still, and rejected the 200, would I still take the trade? Yeah, probably. I mean, they're pretty dang close, right? Like they're pretty close. I mean, the spirit of the whole thing is key support at the bottom of the order block and key support of the 200-day moving average almost exactly right there. So next week, if CCJ did reject the 200-day moving average, I would certainly consider taking it. And the 200 is at 99.30 right now. We're 107.51, so we're kind of a long ways away from that, but we are kind of breaking down. So there is a chance next week that we could reject the 200-day moving average, and I would seriously consider it. And of course, depending on the risk to reward ratio. Next up, CCL. which is Carnival Cruise Line. So Carnival Cruise Line, we have an order block back here from the 30th of March. We broke out of that order block, moved up really nicely, but of course, CCL, Carnival Cruise Lines, and all the cruise lines have been having difficulties with all the news that's going on. But we did enter the order block. So just in general, we are in a potential buying area. Now, there are no moving averages inside of here. I would also take a rejection of the 30 RSI inside the order block, but I don't even know if we're going to get that. But what I do see that I like is this megaphone trend line. A megaphone trend line is when you have a swing low and then you have another swing low that's lower than that swing low, and you connect those bottoms and you move the slope of that line out into the future. Very often, so we've had two touches. We have one touch here, we've had one touch here. Very often when you have a touch, the third touch of that extended megaphone trend line, you may get a reaction there. And what I like about this particular trade is, depending how soon and how quick this happens, but do you see how the third touch of the megaphone trend line is right at the bottom of the order block? So, excuse me, that is a key level by itself. So it's hard with trend lines to know what it's going to look like in a few days. Like, for example, if Monday went all the way down there and rejected the bottom of the order block and rejected the trend line, then almost certainly I would take that because they're dovetailing. If it happens further in the week, or if it even happens, I would be less likely to take the rejection of the trend line when it's outside of the order block. So just to be clear, next week, if we do reject the bottom of the order block and the trend line, I would be very likely to take that. If we rejected the bottom of the order block and the trend line was below us, I would also consider that, because the rejection of the bottom of the order block is always legitimate if it goes under and then closes back over, giving you a good risk to reward ratio. But I guess what I'm really saying, Monday, if we were to reject the bottom of the order block and reject that trend line, that would be a stronger signal. So I'm kind of, in a way, only looking at this for Monday. Walt Disney, DIS. All right, so Walt Disney has had a good little move up here, but we have potential order block. We have a moving average inside this order block. So let's review. Swing low, swing high, lower, swing low, market structure change. As soon as the market structure change happens, we can define the order block, the lowest closing bar prior to the market structure change. Bring this order block into the future. And what I like, when I have an order block, when I have a moving average inside an order block, that's what I really like, because it gives me a very well-defined line in the sand. If we come down next week and reject that 50-day moving average, right now the 50-day moving average is 101.08, I would consider taking the trade. And the 101.08 would be my line in the sand. So, for example, if it had done this today, yeah, I would certainly consider taking that trade, because it rejected a moving average inside the order block, and it's a very good risk to reward ratio. It doesn't mean it's going to be a profitable trade. It just means that, yes, I would consider taking this trade here. Next day, if it closes back under, I get out. I can always get back in the future if it closes back over there. It's just having that line in the sand, out below, in above. All right, so we're not there yet, but next week we are certainly within striking distance of doing that, and I would definitely consider that, taking that trade out if it rejects 101.80. IBB, which is the NASDAQ Biotech shares, this one could get there. We have a kind of a tall order block, but we have a nice 200-day moving average. This is the black line inside the order block. Right now, that 200-day moving average is dovetailing with the negative third ATR channel, which is also a key level. And again, we're still above it. No guarantee we're going there or not. But if we do, for some reason, head down lower and reject that 200-day moving average, yeah, I would certainly consider taking it. It's one of my favorite trades. Rejection of a 200, 250, 300-day moving average inside an order block. Just gives me a good risk to reward ratio. Gives me a good structure to structure good level to structure my trade off of so that if I'm wrong, hopefully I can be wrong small. I have my emergency stop way down there in case I'm really wrong, right? But that doesn't happen very often. So that's what I'm looking for on IBB, rejection of the 200-day moving average inside this order block. Right now, the moving average is 161.36. TLT got hammered today, everybody. It's concerning. The more TLT goes down, the more interest rates go up. The more interest rates go up, the more difficult it is for the economy. So when you have oil prices really high, you have interest rates really high, it's not a good setup for a healthy economy. So I'm hoping that TLT will bounce, because if TLT goes up, interest rates go down. They are inverse of each other. So let's see if there's any potential signals for TLT. And we're pretty close. Look, the RSI right now is 31.24. If I get a under 30, over 30, whether it closes at 29, then it closes at 33 or whatever, or we go under 30 during the day and close back above the 30, that's an intraday rejection of 30, I would definitely consider taking that trade, because that's a rejection of a 30 RSI inside this order block. A rejection of the 30 RSI by itself is a legitimate trade, but it's a much better trade when you're inside an order block, and we are certainly inside an order block. In addition to that, we have a double bottom bullish MACD divergence. All that means is the low over here, if we measure the red bars, they're pretty deep. This is a momentum indicator. Now we are certainly lower here than we were here, but the red bars are not as deep as they were over here. So that's an indication that that's, even though it looks really bad, that selling momentum is less here than it was here. The implication is if selling momentum dries up, then you'll get a bounce. But just because we have a double bottom bullish divergence doesn't necessarily mean just go in and buy. You need the signal first. And the signal for me at this point would be one of two. Either we go under 30, over 30, or Monday, if we were to gap up, then today would be an abandoned baby, which is a bullish signal. And if we get an abandoned baby, I may just take the trade right there. If it involves an abandoned baby, 4 ATR profit target, 2 ATR stop. So this is pretty interesting right here. And we'll see what happens. But either abandoned baby would be an entry, or if we go under 30, over 30, then that would also be an entry, and then my stop would be close under 30. Last one, XLV. All right. XLV's been kind of a wild one. We've closed under the order block, went screaming back above it, which by itself is a legitimate entry signal, but I didn't take this rejection at the bottom of the order block because it was too extended, which I'm glad I did not. But there are three potential levels inside this order block that I'm looking at for next week. The first one, this purple line, is the 250-day moving average. Next week, if we reject that, meaning we go underneath it, close back above it, that's totally legitimate. That's a rejection of a major moving average inside an order block. The 250 at the moment's 144.82. I would certainly consider that. If it goes lower, we have the 300-day moving average here. The 300 is at 143.95. That's also a major key moving average inside an order block. I don't like one better than the other, right? I would take a rejection of the 250. I would take a rejection of the 300, or I would also take a rejection of 143.28. That's the green line I drew here. Why this one, Greg? Because this is an abandoned baby, gap down, gap up. The high of the abandoned baby is a key level of support, 143.28. So I'm looking at three different levels: a rejection of the 250 at 144.82, a rejection of the 300, which is 143.95, or a rejection of the high of the abandoned baby at 143.28. So that's what I'm looking for, everybody, next week. I hope that you enjoyed this podcast. I hope you found it helpful. If you did, I really would appreciate it if you could hit the thumbs up button. If you have any comments or questions about anything, please let me know. I have a baseball game tomorrow. It's a morning game, 9 o'clock. A little early for baseball, don't you think? But anyway, we're looking for our first win this season. So I hope I play better than I have in the past few weeks. I always like to leave off with, please try to go out if you have the opportunity to do something nice for somebody today, just a random act of kindness. Go ahead and do it. It's going to make their day. It's going to be good for you. You appreciate when somebody does something for you. So, why not go out of your way a little bit and try to help somebody out if you can. I'm also a big animal lover. If you have the opportunity to do an act of kindness for an animal, if they come along your path, they appreciate acts of kindness just like we do. So, I think in this current world, we could all give and receive acts of kindness a little bit more than we are. So I have this small little platform, but I always like to leave off with that. So anyway, everybody, like I said, I hope you enjoyed this. If you have any questions, please let me know. God willing, I will see you next week, and have a really good rest of your weekend. Thanks a lot, everybody. Talk to you soon. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.